Have you ever wondered why the 40s are considered to be the make or break decade of life? Well, quite simply, the financial decisions made in one's 40s are the most impactful in one's life. Why is that? There are two reasons for this. Firstly, individuals in their 40s are at the peak earning power and they have higher disposable income and savings. And secondly, as their retirement is coming closer, they have less time to recover from any mistakes they make while investing. So, this video will aim to arm you with all the knowledge of the strategies and skills required to succeed in your 40s and beyond. This video will provide clarity in two key areas: sophisticated financial strategies to increase returns while reducing risk, and creation of a template suitable to your life circumstances, whether it is a financial plan or an investment policy statement. As an extra bonus, we will also cover what steps need to be taken to re-evaluate your financial goals. Hi, this is Prashant Saraf, and you are on my channel Blueprint Investments. I am on a mission to arm 1 lakh investors with the knowledge, strategies, skills, and tools to create life-changing wealth for themselves and their families. Coming back to the 40s, let's start with the basics first. You have learned basic financial principles in the 30s like power of compounding, budgeting, as well as started saving for all your goals by using SIPs. You have also built an emergency fund and paid off high interest debt, and most importantly, you have built a solid foundation for your retirement. 40s is the decade to re-evaluate all your financial decisions. You need to learn new investing skills and also re-evaluate all your goals. After covering the basics of finance in our video on the 30s, now you need to adopt sophisticated financial strategies that have superior risk-return profiles. While you still need to allocate your assets between the 4 asset classes of equity, debt, gold, and commodities, you need to calibrate them so that you can earn higher returns with lower risks. You have learned that diversification is important to manage your risk. But how do you diversify? Well, there are many ways to diversify. You can diversify geographically and also based on strategies. If you have been granted stock options, then your salary and investment income come from the same source. You may need to diversify your investments by reducing your exposure to the company where you work. Now we come to the heart of this video, which is the investing strategies that you need to follow in the 40s to earn superior returns. To do this, you need to follow proven strategies that have worked in the past and have generated superior risk-adjusted returns. In our video on investing in the 30s, you have already learned about asset allocation and how to choose investment products. Now, it is time to improve your returns further by recalibrating your investments in each asset class in a better way. In this video, we will cover the strategies that investors can use to improve returns in equities. A few of these strategies are long-term compounders. These are stocks of quality companies. They can be identified by looking at the average return on equity of these companies. Long-term compounders generally have returns higher than the cost of capital on a consistent basis. To maintain the high return on equity, long-term compounders need to have a durable moat. Moats are of different types. 3 of the most common moats are the low-cost moat, the distribution network moat, and the brand name moat. The next strategy that we cover is growth at a reasonable price, or GARP as it is popularly called. In this strategy, we are still looking for quality companies. However, the consistency of performance may not be the same as that of long-term compounders. This is because these companies have a narrower moat than that of the long-term compounders. So, the distribution advantage or cost advantage or brand recall is not as dominant as that of the long-term compounder. As an example, you can look at a company like ITC, which has many popular brands and an extensive distribution reach. However, its return on equity and growth rates, as well as slight inconsistency in performance, put it in the category of growth at reasonable price rather than as a long-term compounder. Another strategy savvy investors use is called the Global Cyclically Adjusted PE Ratio Strategy. Though the strategy is quite a mouthful, its essence is very simple. The First rule of the strategy is to invest in the cheapest quartile of major international stock markets based on the PE ratio. As an additional filter, this strategy would not invest in the countries where the currency is on a weakening trajectory or where inflation is strengthening. The next strategy that we are covering here is the dividend growth strategy. This strategy is extremely popular among the more conservative investors. Under this strategy, investors invest in cash generating stocks with growing dividends. The final strategy that we are covering is the macro investing strategy. These strategies start with a deviant perception of the macro landscape for the next decade, which if true, could make a lot of returns. So, in the current geopolitical context of decoupling of supply chains, there is a high likelihood of high inflation and commodity shortages for the next decade. This would suggest that investments in certain commodity stocks can be highly profitable. Few commodities that are expected to do well in such a scenario are copper, oil, natural gas, agricultural commodities, as well as precious metals. Now we come to the planning part of the video. An important decision that investors need to re-evaluate in their 40s is the type of planning they need to do. Financial planning is more suitable for those investors whose goals are more and whose resources are limited. The focus of financial planning is to make investors achieve their goals easily. Investment planning, on the other hand, is for those investors whose resources are more than their goals. The focus of investment planning is to make investors achieve higher returns while taking lower risks. For those who are planning to continue with financial planning in their 40s, they need to reevaluate all their goals, as all these goals are now 10 years nearer. First up, the child education goal needs to be thoroughly evaluated. Assuming that your investments have done well, you would be very close to your goal target. In that case, you need to look to protect your goal. Instead of removing all your equity in one go, you can do this via a systematic transfer plan from equity to debt. Next, your retirement goal needs to be re-evaluated. This is because with increasing income, your lifestyle would have gone up. For instance, you used to frequent food courts. Now, you dine at fancy restaurants. So, the retirement corpus that you had planned 10 years ago might be insufficient now. To stay on course to achieve this goal, you may need to increase your investment contributions. Another aspect to re-evaluate is your insurance policies. While your life insurance and health insurance policies are probably already in place, you may need to increase your life cover, as the expenses that have to be covered in your absence have gone up. On the other hand, if you have already built up sufficient assets, this would reduce the need for life insurance. You may also need to review your health insurance cover, as the costs of healthcare have gone up due to medical inflation. If you are thinking about early retirement, you need to check if you have saved enough. You can do this with a financial calculator. Otherwise, you can use a rule of thumb. At age 60, you would need 25 times your annual expenses. If, on the other hand, you plan to retire by the age of 50, you will probably need at least 30 times your annual expenses. You may also be contemplating to start your own business. So, in that case, the emergency fund needs to have 2 to 3 years of your expenses as a corpus instead of the usual 6 months. With this, we complete our video of investing in your 40s.